So simulating stock prices, we've done a video on this in the past, but I actually made some updates to the stock simulation Excel sheet, the Google Sheets sheet that has made it significantly easier to use. So I just wanted to do a recap on what's going on in that sheet, how stock prices are being simulated, and then go through a very quick tutorial on how to use it. If you guys would at all find that interesting, and I dropped the link over there. I'll also link it in the description of the video that we're going to upload a little bit later. But just to recap, we have a video diving into this topic in much more detail, but just to recap kind of what's going on, stock price simulations, this formula is going to come from the Black-Scholes model. It asserts that stock prices follow a geometric motion, a Brownian motion with constant drift and volatility. And through the Black-Scholes formalism, we can actually find a solution to the stochastic differential equation that gives us a way to model stock prices. So we are going to, via these Black-Scholes assumptions and via these solutions, model stock prices in the future. And we assume, again, based on this formalism, that stock prices have kind of two primary components. One is a deterministic component, and we use kind of parameters about the stock price, such as average returns, expected volatility. We're using variables that we measure about stock price dynamics to construct this deterministic component. So we assume that there's some part of stock price movement that we can kind of predict. That's our deterministic component. That's what this means here. And then we also have a stochastic component, which kind of simulates randomness. So we assume that when a stock price moves, there are these two kind of forces that are moving it. One part that we can kind of predict over periods of time, and one part that adds this element of randomness that prevents us from predicting it with 100% certainty, right? And these two components are kind of what we assume are going to fundamentally drive stock prices. And we can use this formula, this approximation from the Black-Scholes formalism to actually evolve that stock price in time in our simulation. And again, we have videos that kind of go through this in much more detail, but this is just a bit of a recap to show what's kind of going on in the background of the sheet for anybody who is interested. So this sheet that I'll show in a second is going to simulate stock prices, but it also is going to repeat that many times to do a Monte Carlo. Talk about that in a second. But we can use this equation to very simply model stock price dynamics over some forecasting period using our sort of standard normal distribution to simulate that component of randomness that comes from the Black-Scholes model. But for example, over 250 trading days, so a year, we can simulate how a stock price moves in time according to this model. If we repeat that process many, many times, then we can run a Monte Carlo, which enables us to look at a distribution of possible outcomes, again, according to this very simple model for price dynamics, which allows us to look at risk in a probabilistic way. We can look at probability of profit, we can look at worst case loss estimates, as well as other statistics from these simulations in a probabilistic way. And it allows us to do a really interesting kind of analysis in terms of managing risk, in terms of building a trade, setting a trade up, managing all those different factors. Hopefully this all makes sense. This is recap. But now I'm going to get into the actual spreadsheet, which I think is a lot easier to use. I'm going to go ahead and zoom this in real quick. Let's see if we can do that. So this is a variation of the spreadsheet that we showed in some of our previous videos, except now it's actually easier to use because you don't have to plop in the prices yourself. You can actually just pull them from a function actually that Google provides, which is super cool. So let's say, for example, I want to simulate SPY prices. So, the S&P 500, that ETF, let's say that I want to, simulate prices using this method that I talked about over some period of time. All you have to do is drop in the ticker and then pull from a little bit of data because we have to measure some of these historical variables, for that deterministic component. So we just have to put in our stock ticker and some amount of data to kind of pull from to sort of initialize that model. So let's say that I want to pull SPY, or actually let's say that we want to pull Apple. So I want to pull Apple stock from 2023 to 2024. And then it'll actually pull in that data so you don't have to go get it yourself. Right now it's loading, but now we have pulled in the data. And now that makes that whole step a lot easier. So we want to simulate Apple prices. We need some historical data in order to do that. So I'm going to put in the range for my historical data here. Let's say 2023 to 2024. You pick where you want the simulation to start from. This sheet will automatically pull the current price. But if you want to override that, if you want to have it start from a different price, for example, maybe you want to do a back test and you're like, well, I want to use the starting price in 2015, for example. Then you can adjust that here, but it's going to default to the current price of the underlying. you choose how many trading days you want to simulate. So here we're going to do 30 trading days. It's very important to remember that these are not calendar days, trading days, but we're going to pick 30 trading days. And then our number of simulations. So let's say that we want to repeat this 200 times and do that Monte Carlo on those 200 different simulations, again, over 30 days. That's all you got to do. You just change these couple of cells, and then this sheet is going to actually run that simulation. So we picked 30 trading days. You can see that's here. It automatically updates it. If we kind of scroll to the side very, very far over here, we can see that we have done our 200 price simulations. So each one of these is a simulation that is running, and it's going to go up to 200 because we picked 200 for that variable. And then this tab is going to give you the results from all of those simulations. So you can actually see, for example, the first 10 simulations over, again, those 30 trading days. You can see your probability of profit. You can see your best performer. You can see your worst performer. You can see the cumulative percent change, that distribution of those investments over time. And then you can also take the data and do your own analysis, which is kind of cool. Let's say that instead of, Apple, we want to look at let's look at Amazon or NVIDIA. Fuck it. NVIDIA from 2023 to 2024, you just hit enter. It pulls that data. And you can pick, a year of data to use, 2 years of data. You can pick different ranges depending on how you want to, sort of simulate the dynamics. Let's say that instead we want to simulate 15 days. So looking at the next 3 weeks, remember that these are trading days. So 15 trading days is about 3 weeks. And we want to run 200 simulations. You just go to the simulation data and you got your 15 days worth of simulations. You got, repeated 200 times. And then you can actually see the results and do your analysis on them, which is kind of cool. It's actually a lot easier to use, which is actually, this came from people's recommendations in the comment sections. They, hey, you can do this XYZ thing, which actually allowed us to update it in a pretty cool way. So I'm really, it's so much easier to use. I'm very happy with it. I'm going to update the options one as well. We do also have an instructions page. So if you are more of a, visual learner, I guess, and you want to, instead of watching a video for the tutorial, if you want to just kind of go through it yourself, all of the instructions that I kind of went through are listed in more detail here on the instructions tab, and you'll be able to find it there. So I'll link this sheet in the description. I linked it over in our live chat as well. So if you guys want to go check that out, I think it's a lot easier to use now, which is cool. All you have to do in order to use it, because this is a template, so you can't actually edit this version, is if you click on this link, it's a little annoying, but that's the way that Google does it. If you click on this link, you'll be able to copy it into your own drive, so you'll be able to edit it yourself. So that's what this kind of orange thing means. You won't be able to edit this actual sheet because, again, it's a template that everyone needs to be able to use, but you can copy it yourself. You can choose to keep the old sheet, but this does exactly the same thing. It makes it so much easier to use. So it's been really fun to kind of learn more about the software and all the different cool aspects of it, which is neat.